Okay, so the next reading is reading 45, company analysis forecasting. This is a simple reading only, but a good reading. Okay, company analysis. So how do you forecast basically? How do you forecast? See, this in this one, uh, you may not get questions, but it is a good one to read. Okay, or even if you get questions, you will be able to tackle it, you will be able to solve it, but the content provided here is good to understand the business better. Okay, so without reading this, can you still solve the questions? Yes, you can. Okay, but I would still strongly suggest you to um, uh, read this reading as well. It's an easy sorry, it's an easy reading only. Okay, now how can you forecast financial statement lines with clear drivers? So what do you mean by these clear drivers? That means financial statement lines with clear drivers. That means the way example they have given here, that the way number of stores are going up proportionately, financial statement, sales, net profit, everything is going up. So in that case, what is the driver here? How can you forecast? Based on the number of stores that are operating or that will be opened up, and sales per store. So this is good for FMCG companies. So it is a clear driver. Okay, so how will you forecast basically? So you will forecast based on number of stores that are coming up. So this can be applicable for DMart, or it can be applicable for, let's say, gold selling company like what, Kalyan Jewelers, Senco Gold. For this kind of company, it will work. Okay, or Tanishq. Okay, then financial statement without clear drivers. So without clear drivers, so here, how will you get the idea? So here the drivers, without clear drivers, an analyst can forecast these items directly using estimates obtained from management or by adjusting amounts from prior years. So obtained from management. How will you know from management? How will you get this information from management? Remember, I told you con call in YouTube. You can type whatever company you want and type con call. So you will get to know the con call. That means conference call of all the analysts, wherein analysts will ask questions and the management will give the guidance. How they have performed and how they will be performing, and what can be expected in the next upcoming quarters. So you will get an idea from the management. Okay, and also when you look at the annual report, you can Google about the annual report. When you Google and when you download the annual report, in that annual report can go for 200-300 pages around. So in that annual report, there will be one page dedicated for MD&A. MD&A means management discussion and analysis. Management discussion and analysis. So management discussion and analysis means management means what? Management means chairman, CEO, directors. They will put forth their thoughts and they will do the SWOT analysis. SWOT analysis means what? That strength, weakness, opportunities, threats. So what kind of opportunities they are finding in the market and what are the challenges? So challenges can be geopolitical challenge, Trump tariff. Okay, so this kind of challenges, or any particular raw material price going up, or the inflation going up, the interest rates going up. So these all they will be discussing. So you will get an idea what is the direction that the company is giving. Okay, that is, it is not clear driver because these are all kind of indirect stuff, right? Whereas operation, number of stores is a clear driver. Okay, number of stores, sales per store is a clear driver. That means clear number. Similarly, for many other companies, they will give the order book that they are getting. They will give the order book. So order book, or automobile company will say, like, how many cars they are selling. So such kind of reports are direct one, and these are indirect. That means basically this is telling you about what is happening around. Okay, then summary measures. That means metrics such as earning per share or free cash flow combine several financial statement line items. Forecasting summary measures is most effective when they are not subject to significant period to period fluctuations. That means, yeah. So that means, uh, based on the EPS history of EPS, you are forecasting how it is going to change further. So you can think, like, at what rate it has been growing, and so at what rate it can be expected to grow further. Okay, that is metrics. Then anything ad hoc means in anything additional. Okay, an analyst might want to account for events, anything ad hoc, like windfall from an expected victory in a lawsuit, or regulatory changes requiring future cost to comply. Windfall means huge change. Windfall is in huge change. Huge change, when will it happen? Imagine suddenly the oil price comes down highly. So quite possible that certain oil companies will be able to get oil at a very low price. So that time they will make huge profit. That is called windfall. Okay, windfall. Okay. So these are four forecast objects. You don't have to remember as such, but reading once is okay. And as I said, this topic, even if you don't read and if you look at the questions, you should be able to tackle it. Okay. Then, uh, base forecast. Assume results will converge to a historical base rate. Use management guidance and use other methods to make discretionary forecast. That means, apart from that, whatever management has given, you may want to change based on your discretion. What you think will happen. Say, for example, the way it's raining. So you can say, like, okay, because of this, the crops will be good or the crops will be bad, and so this is how it is going to impact pesticides company. That way, you can also have your forecast. Then, yeah, these are all very common points only. Yeah, top down revenue forecast. So top down means what? Top down is in, you will see at what rate, you will see the macro variables. What do you mean by macro variables? Like, for example, at what rate GDP is expected to grow. If this, whatever rate GDP, let's say 7%. Now, if GDP is growing at 7%, which sector is contributing? Different sectors are contributing, right? So let's say this is defense sector. So assume that defense sector is contributing maybe 10 percentage. So you know that, okay, in this 7 percentage growth, defense sector is going to contribute 10 percentage. Now in this defense sectors also, there are many industries. One can be about, maybe drone companies, drone making companies. Another one can be like missiles. Another one can be like something like robotics one. Another one can be like giving IT solutions to all these okay, IT solutions to all these defense companies. Now within that, how many drone companies are there? How many missile making company, robotics? How many IT companies are there? So based on this, see, like defense sector has 10 percentage. In this 10 percentage, what is the market share of drone companies? Drone companies might have the market share, like, this is maybe 25. They may contribute 10. They may contribute 35, like this. They all are contributing in this one. And in this 25 percentage, now drone, company 1, company 2, company 3, company 4, 5 are there. So how much are they contributing? So normally, what is their contribution? And so how much the sales should go up by. This way, when you predict, it is called as top-down revenue forecast. Then what is bottom-up revenue forecast? Bottom-up means within the company. So within the company, like yeah, these are all the drivers. At what price and volume? Average price and volume. Okay, and then so in this average price and volume, they are, imagine they are reducing the price. So how much the volume will pick up? Okay, and then what is the product line and segment? If they are introducing new product line or new segment, then how much further sales will pick up? Then how much capacity based measure? An analyst may forecast revenue growth for a company's existing locations and add a separate forecast for its newly opened locations. So capacity, new stores when they are opening, how much further growth can come because of new capacity expansion. Then return on yield based measures. These involve forecasting balance sheet items and the return the company will earn on them. For example, interest revenue forecast for a bank require changes in loan balances and changes in customer deposits. Bottom up revenue forecast. Yield on revenue based measures. These involve forecasting balance sheet items and the return the company will earn on them. For example, interest revenue forecast for your bank require interest revenue forecast for your bank require changes in loan balance. Yeah. So this is an example. Okay. Example, interest revenue forecast for your bank requires how much loan will change and how much customer deposits will change. Based on that, you can predict this one. Okay. Okay. So these are all the revenue forecasts. So this is basically, you can say, income from other sources, also returns or yield based measures, forecasting balance sheet items and the return the company will earn on them. Okay. Yeah. So other income for manufacturing company, and for bank it will be the core one, interest revenue. Okay. Have you understood this one? This is okay. Bottom up revenue forecast.
Yes, sir.
Okay.
Clear.
Yeah. Recurring and non-recurring items. Recurring means which will keep on happening every time. Non-recurring means once in a while. Like for example, selling of land and making profit. It is a once in a while profit. Every time you are not going to sell land. That is not the core business. Okay. Then forecast approaches. Yeah, this is all okay. Yeah, we can do this sum. Okay, the sum is a good one. Just go through this question. The effect of prices and costs on gross profit and margin. Okay. Okay. Yeah. The effect of prices and costs on gross profit and margin. So now period one, sales is 100, gross profit is 10. Okay. Okay. Acha, they have given all the numbers. There is nothing to calculate. They said cost of goods sold is a percentage of sales that equals 25 percentage. That means if cost of goods sold is 25 percentage, cost of goods sold, sales, cost of goods sold, gross profit. So cost of goods sold is 25%. That means if sale is 100, okay, cost of goods sold will be 25% of that. If input cost is double in period 2, that means this is doubling to 50. And the company can pass the entire increase to its customer through a 25% price hike, because here it has gone up by 25. So here I'm passing on those 25 to sales. So it will become 125. So in that case, what will be my gross profit? It will be 75. But what will be my COGS percentage? So here COGS percentage is equal to 50 divided by 125. Just calculate 50 divided by 125, this one, into 100.
40%.
40. So initially it was 25% cost of goods sold. Now it has become 40%,
So how did the sales become 125 for the
because
second year?
they said they have passed on the cost, pass on the entire cost, entire increase to its customer through a 25% price increase. So this is
Okay.
100. This
Uh,
entire 25 you have pushed it
yes.
to the customer. That means they will be
Okay.
paying 25 more.
So in the second year, I've raised the price, like I've increased the prices.
Yeah,
That's
yeah,
it.
yeah.
Okay.
So basically, because of an increase in the input, the price is going up, right?
Correct. Okay. So the cost is, you are doing the business. For you, the cost has gone up. Let's say for raw materials. So what have you done? You have pushed that price to the customers. You have added that to the sales amount and you have increased the price. So now customers are paying. Okay. So, but your cost of goods sold has gone up. Initially it was 25%. Now it is 40%. Okay, 40%, because an equal absolute amount has been added to the numerator and the denominator. So earlier, see, earlier your cost of goods sold was 20 by 100 into 100. That is 20%. Here now it is 40%. Your gross profit margin is equal to 75 divided by 100. 100 is, this 100 means sales. Okay, this is the base. So that is 75%. Over here, gross profit margin is equal to 75 divided by 125 into 100. Now you calculate.
60%.
So now you see your gross profit margin also has come down. Cost of goods sold also has come down. Okay. This is the effect of prices and costs on cost of goods, on gross profit and margin. So when the prices are going up, this is how your business uh, metrics gets impacted.
Okay.
Okay.
Yes.
Okay. Then, so all these, if you want to read all uh, these all, anyways, we will be learning this in another subject. Okay. Another subject, FSA, we will be learning, and corporate issuer also we will be learning this one. So here in equity, you can afford to ignore. Uh, yeah. Or should I explain this now? Just I'll explain them. Let me just finish this up. Later on, again, when it comes in another subjects, again I'll explain. Even though it is not relevant in this subject, Let me still explain. But it is a relevant topic. Okay, in this subject, it is not that relevant, but it is a very, very important topic in other subjects. FSA, it is a very important one. So you see management of working capital. See, uh, it is called as activity ratios. Okay, activity. It will tell you how working capital is referring to activity. Okay. So activity ratios here, number one, account receivable. So account receivable turnover ratio. Now, what does this mean? Account receivable turnover ratio. That means credit. So account receivable. When will you receive? When you do credit sales divided by average account receivable. Okay, credit sales divided by average account receivable. What does this mean? This will tell you how many times uh, creditors are paying you. No, not creditors, sorry, debtors. How many times debtors or account receivables are paying you in a year? Are paying you in a year? How many times they are coming and paying you in a year? Say, for example, you are doing, let's say one credit sale of 100 rupees, and then you are creating what? Account receivable 100 because it's a credit sale. And then, and then, um, okay, and then, uh, let's say next entire month, after 1 month, again you are doing, after 1 month, this person is paying to you. That's it. Then that means it is gone. Now again you are doing a credit sale of 100. Then again after 1 month, this person comes and paying to you. 100 is gone. Then again you are doing 100 credit sales. Again this person credit sale is there, and next month giving you 100. So this 100 is gone, and you are doing another sale of 100. So every time you are doing credit sale of 100, 100, 100, and you are creating receivable also 100, 100, 100. Just imagine you keep doing this. So when you keep doing this, that means how many times, what is the total sales you have done? 12 times in a year, every month it is happening, right? So that means 12 times. So 1200 you have done sales for. In a year, you have done sales for 1200, 12 times. And every time, what is the receivable that you have in your book? 100. So that means this is 12 times in a year. Account receivables are coming and paying to you. Okay, so this is giving you the answer, like how many times your debtors are coming and paying to you. 12 times. 12 times. Now you want to know, okay, 12 times they are paying, but after every how many days? How often? Now there is another ratio called as days of account receivable, days of account receivable, days of account receivable turnover ratio, or days of account receivable, or days on hand. Inventory, no, not inventory. Yeah, days sales outstanding. Yeah, or we can also call this as days of sales outstanding. So here the formula is days 365 divided by account receivable turnover ratio. So that means 365 divided by account receivable turnover ratio is 12, right? So divide this, how much are you getting?
30.4.
So 30.4 means 30.4 days. That means it will tell you how often account receivables are coming and paying you. Often account receivables are coming and uh, paying you. How often? Not how often. Like after how many days? After how many days? After every how many days? After every how many days account receivables are coming and paying you. Okay. After every how many days account receivables are coming and paying you. How many days? 30 days. So you are getting an idea, right? After every 30 days account receivables are coming and paying you. And how many times are they paying in a year? 12 times they are paying in a year. You got the idea? Now, does that mean this 12 is a very good number or this 30 is a very good number? We don't know. So then what is the right number? The right number is you have to match it with the industry. So in the industry, what is the trend? Okay, if the industry, after every 30 days, if account receivables are paying, then it is okay. Okay, if the industry is 60 days and here it is 30, then it is not a good sign. Okay, why it is not a good sign? Because you are taking money from them too soon. Now, if you are taking money from your debtors too soon, they may leave you then. They will go to your competitor. Okay, and suppose if you are taking too late, imagine industry is 10 days and you are taking money in 30 days, then also it is not a good idea because then you are giving too much of time to your debtors. So that means you are blocking your working capital. That means, okay, you understood the importance of this one. This will tell you how you are managing with your debtors. How are you receiving money from them? Okay, so this 12 and this 30.4 should be at par with the industry standard, which will differ from sector to sector. Okay, or industry to industry, it can differ. Next one is similar thoughts only. Next one,
Like the lesser it is, the better, right? Like they are turnover.
which one? Lesser is
The
better.
second one, like
Uh,
both of them, right?
no. That's what I said. You don't have anything, lesser is better or maximum is better. Say,
Okay.
for example, this one, lesser is better. How can you say lesser is better? Let's say this is 2. That means they are paying only 2 times in a year.
Okay. Yeah.
Only 2 times they are paying. And here, if I take 2, then what will come as uh, days of inventory turnover ratio? 182 something.
Yeah.
So after every 182 days they are paying, then your money is blocked.
No, I mean the second one, the lesser it is, the better, right? The
And
second one, days of ER turnover ratio.
lesser, okay. So let's say lesser means, let's say
Yeah,
10 here.
it's less than, yeah, let's say it's 10. So
It's 10. Now that means after every 10 days they are coming and paying you.
yeah.
Now suppose in the industry it is every 30 days. That means industry is giving them the credit limit of 30 days and you are giving the
Mm,
credit time limit of 10 days. 10 days.
10 days. Yeah.
Now you tell me, uh, don't you think your clients or your debtors, they will soon leave you? They will not purchase goods from you because you are not giving them enough time limit,
Mm,
right?
mm.
You are giving them only 10 days time. So why
Yeah,
will they?
that can happen.
So that's why it is dangerous. Neither it should be too much nor it should be too less, because here you may be happy to collect it sooner, but then
Mm,
somewhere they will think, no, that they are paying you too soon. So why should they pay
right,
you too soon?
right.
Yeah. Okay, this is fine. This is okay. Then, so this is account receivable. Same way I can, write for accounts payable. So accounts payable turnover ratio. So the formula is accounts payable is related to what? Credit purchase divided by average accounts payable. So imagine you are doing a purchase of 100 credit. Then after 1 month you are paying, and then again you are making a purchase of 100 on credit. Then after 1 month again you are paying. Then again you are purchasing for 100. This you keep doing. So every time you have credit purchase of what? 100, 100, 100, and you keep doing every month. So imagine overall total credit purchase you have done is 1200, and every time average accounts payable is 100. So that means what? That means 12 times in a year you have paid. How many times in a year you have paid? Okay. Now you want to know how, after every how many days. So this is how many times. Now you want to know after every how many days. So that will be days of accounts payable turnover ratio. That is equal to credit purchase divided by average accounts. No, sorry, this is 365 divided by average accounts payable turnover ratio. Uh, accounts payable turnover ratio is how much? 12. So that means after every 30 days you are making the payment. After every 30 days, okay, we are making the payment. Hmm. Is this okay? Understood this one?
Yes.
Yes, sir.
Yeah. Okay. Next one is so this is about managing accounts payable. Now here also accounts payable. So here, if the turnover is less, it is good only. You are paying less number of times. But then if you have control, you can over exploit. But if you don't have control, then the the counterparty will not supply only goods to you, because you are purchasing and you are taking too much of time to repay. That risk is there. Otherwise, if you can control the situation and if you delay, then it is okay. Okay. Then next one is inventory turnover ratio. Inventory turnover ratio. That is equal to cost of goods sold divided by average inventory. Okay, that means what? Inventory turnover. That means after every how many days you are going to the market after every how many days, no, after how many times you are going to the market in a year, how many times you are going to the market in a year to buy inventory. Okay, example, imagine throughout the year cost of goods sold is 1200, and at a time, average inventory that you have is 1200. That means 12 times in a year you are going, 12 times in a year you are going to the market to buy inventory. Now, is this too much or too less? It should be at par. Now you have to check with the industry standard. Okay, that means it, as I said, it will differ from industry to industry. So whichever industry it is into, it has to be checked with that. Then uh, days of inventory turnover ratio, also called inventory days on hand, DOH. DOH, that means inventory days on hand. Inventory days on hand. Here the formula is cost of goods days, na? So 365 divided by uh, inventory turnover ratio. Inventory turnover ratio. 365 divided by inventory turnover ratio is 12. So after every 30 days, we are going to the market to get inventory. That means after every 30 means after every 30 days, we are going to the market to get inventory. Okay, see, these formulas are very important one. You should write it down. What you should do is you should buy one rolling whiteboard paper. You can get it from any big stationery shop. So you should ask them rolling whiteboard paper. Okay, rolling whiteboard paper, like this you ask them. So they will give you paper. It will come to around 100 rupees also. 100, bigger one if you go for around 120 rupees it should come to. You buy this rolling whiteboard paper, then your duster and marker also. So marker and duster as well. And you can write all these formulas over there and hang it to your wall. Okay, when you hang it to your wall, you will see these formulas every day, so that by the time exam comes it sticks to your head, and then you don't have to worry about memorizing all these stuffs. Okay, otherwise at the last stage, if you try to memorize, you may not be able to do it successfully. Then your confidence will come down. So that's why right from the beginning itself you follow this. Let all formulas be in front of your eyes in your home, and then you can keep writing test also as and when you feel like, once in a month or so, or once in 2-3 weeks, of all these formulas. Okay, you got the idea. This is okay. This is what it is all about. Okay, now another one, yeah, if I continue another, there is one more small topic continuing this. There is something called uh, CCC, that means cash conversion cycle. Okay, so cash conversion cycle. cash conversion cycle. That means basically how many days it is taking for you to convert it into cash and then bring money back into business. So basically you are locking your money when you are buying inventory. So days on days of uh, days of inventory, days of inventory, yeah, days of inventory turnover. Okay, plus. So let's say you are buying and keeping it in the godown inventory for 30 days. Then after that you are selling. When you are selling, you have to again give credit. So let's say days of accounts receivable turnover. So that is, let's say for example, uh, 60 days taking. Okay, 60 days. So you are taking 90 days. But however, even you are using somebody's money, right? You are also buying on credit. So that you will minus days of accounts payable turnover. So that will be minus uh, let's say you are taking 50 days time to pay. So that means 30, 60, 90 minus 50. So 90 minus 50 is 40 days. Okay, so 40 days. Now this number, lower is better. Okay, lower is better. Lower is better means what? Suppose instead of 50 here, assume you are taking 100 days to pay. That means it is minus 10. So what does this mean? That means you are not using your own money at all. Very good business for you, because here from here you are uh, you are taking 100 days to pay, and that money you can utilize it over here. That's it, and still you have 10 more days to save. So if it is cash conversion cycle is in negative, it is excellent. Okay, and there are also certain businesses where it is in negative. Okay, I'll just show that. See, screener.in, go to search, type Hindustan Unilever. Hindustan Unilever, and you see, okay, you can see here that those days. Can you see here cash conversion cycle? All this, see, days payable. This is inventory days. This is determines account receivable days. Okay, so for them it is around 22 days. Okay, so they are waiting for 22 days. Then this inventory is there in their godown for 60 days or 59 days around. Days payable is 152 days. See they how much time they are taking to pay. See this one, cash conversion cycle is minus 72, 71. So good business no, for them. So they are pressurizing their suppliers. Okay, because they deal with many suppliers, right? And they buy in bulk from them. All small suppliers they have tie up with. So and that's how they are able to put pressure. 71 days minus 71 cash conversion cycle. Is it okay? Understood this one?
Yes, sir.
Okay. Similarly, now you can see the competitor also. So competitor is, you see the competitor here, ITC, Hindustan Food, Godavari, what is this? Bioref. Okay, let's see this ITC or Hindustan Food. Okay, Hindustan Food. What brand is this Hindustan Food? Um, is there any known product? Okay, so Hindustan Lever is also your client. Bata India, PepsiCo, Wipro, Godrej, US Polo. These are all the client. Their brands. I have never heard all these. Okay. Okay, anyways. So here, what is their cash conversion cycle? 51 plus. Okay, 51 plus. Not so good, no? Then, in comparison to Hindustan Unilever. Then ITC. So ITC is a popular company, right? That tobacco, all that stuff comes. And they are also into paper. FMCG also they are into. Okay. And agro business as well. So here it is too high. 146 cash conversion cycle. Inventory, they are keeping it in inventory for a long period of time. 178. Okay. Okay, understood. This one is fine, right? Okay. So I'll close this now. So this is a very important one, okay, what I have covered. Not in this subject, but in other subject. So next time again I will be covering, but very important one. Okay. Yeah. Then forecasting capital investments in tangible and intangible assets require an analyst to use the cash flow statement to determine acquisitions and dispositions, and the income statement to determine depreciation and amortization. This we will be learning in FSA. Okay. So you don't worry about what is cash flow statement. Basically, it is all about only taking the cash transactions of the company. Okay. Ignoring all credit sales, credit purchase, all those things. We will see that in detail in FSA subject. Okay, reading 46. Yeah, reading 46. Equity valuation concepts and basic tools. Yeah, intrinsic value. Okay. So first, what I will do, so from here only, all calculation related topic begins. Discounted cash flow and all this. So I'll explain this, but before that, let me explain this part. These are all cash dividends, We have already discussed stock split, right? Stock split and bonus. Stock dividends means bonus only. Stock dividend means bonus. Okay. Stock dividend is bonus. We have discussed, do you remember stock split and bonus in when we were doing this price weighted index?
Yes, sir.
Stock
Yes,
dividend,
sir.
yeah. Okay, then stock split also we discussed. Reverse stock split means what now? Reverse stock split means in stock split, once one stock is split into multiple parts. One stock in stock split, one was split into multiple parts. In reverse stock split, what happens? Multiple stocks will be clubbed together. Like in stock split, what happens? Imagine that I remember I told you like this: quantity, price, total price. So quantity is 1, price is 1000, total 1000. Now it is split into two parts. So 2, that doesn't mean you are going to get anything here, but price per share will come down proportionately. This is called stock split. Okay. The next one is reverse stock split. Reverse stock split means uh, reverse stock split means, now imagine you have 10 stocks and 10 stocks whose price is let's say price of 1. This is price per share. So price per share is 1. So total amount will be 10. Now this company is worried that when the price per share is 1 rupee, what if you know it is 1 rupee? So what if the price, suppose COVID happens, war happens, and what if the price comes to 50 paise, 40 paise, 30 paise, and then if it comes to zero, then the company will be delisted because its market value will become zero. Okay, it will be delisted from the stock exchange. So the company is worried. So what they are doing is they are clubbing multiple shares together into one. So they are saying, look, 10 shares I will consider as one. If 10 share is considered as one, total amount will remain the same. That is the rule. So price per share will become what? 10 rupees. So now if you are having 10 shares in your account, you will end up having one share only, but you are not going to lose out any money. You will still have 10 rupees in your account. So now you see price per share has gone up. Okay, price per share has gone up. Now people who don't know this, they will think that, oh, something good is happening within the company, and that's why the share price has gone up to 10 rupee from 1 rupee. And then they will go into the company and then they will get trapped. Okay. Whereas there is nothing changing in the fundamental of the company. Yesterday also it was a poor company. Today also it is a poor company. Only the packing is changed. Yesterday yesterday's 10 shares, today it is representing as one share. And that's why just proportionately the amount is changing. It's not that the price is going up. This is called reverse stock split.
But the market cap remains the same. Like, so what's
Yes,
the
yes.
use of this, sir?
Yeah, because now the price is 10 rupees, right? Now, if there is
Yeah.
any COVID, anything happens, it is difficult, for the price to come to zero.
Okay.
Okay, that is the reason. Okay.
So that people don't panic. That's why.
Yeah, yeah, yeah. It helps the company as well, right?
Yeah.
Helps in the sense the price will not come to zero.
Right.
Okay, that is the reason. Okay, next one. Share repurchase means they are buying buyback. Share repurchase means buyback. Okay. Then yeah, next one, dividend chronology. Okay, dividend payment chronology. So dividend payment chronology. Dividend payment chronology means certain dates are there. Dividend payment chronology. See, imagine today is what, 4th June, right? 4th June. 4th June. Uh, company is announcing dividends, declaring. Today's date is called as declaration date. Today they are declaring. So declaring what? That they will pay dividend. Okay, when? So they are saying we will pay dividend on. It will take 1 month's time to do the back end work. So they're saying we will pay on, let's say, 15th July. So this is called as pay date. Pay date. Okay. Now payable to whom? So payable to whom? Because every now and then the ownership keeps changing in the market. Anybody can buy and quickly they can sell as well. So payable to whom? So now, so the company is announcing one more date. So they are saying we will pay to all those people whose names are there on the book of record as the owner on 10th July. This date is called as record date. Record date. Okay. So record date means the date on which whoever is the owner, dividend will be paid to that person. That means company says it doesn't matter who is owning the shares on 9th July. For me, it doesn't matter who is owning the shares on 11th July. 10th July, end of the day, if your name is there on the record, I will pay dividend to you. That is record date. Okay. So now imagine you are reading this on the newspaper. Today is 4th June. And imagine this is Reliance company shares. Now you are interested in dividends, but you don't have money now. So you are thinking, what is the deadline for me, so that I can arrange money. So suppose if you buy Reliance shares on 10th July, will you get dividend?
No, sir, I don't think so. Like,
Okay, why so?
is it T plus one or T plus two right now?
Yeah, right,
It's T plus one, so
right.
it won't. We won't get the dividend, right?
Yeah, in India, yeah, it is T plus one. Let's go by US method now here. Okay, let's say this is some US company. So there it takes T plus 2 working days. What do you mean by this T plus 2 working days? That means if T means trade date, T means trade date. So if T, that means imagine this is Monday. If this is Monday trade date, then T plus 1 will be Tuesday, which is what, 11th July. So trade you are doing on 10th July. in US it takes T plus 2 working days for your trade to get settled. Settle means to change ownership. So T plus 2 is Wednesday. So 12th July you will become the owner. But then which date is important for the company? 10th July. But then 12th July only you will become the owner. Okay, so what will the so company will pay dividend to you, that means to the new buyer or to the seller? What do you think? Any idea?
Sorry, sir.
See, 10th you have entered into the trade.
Yeah.
It will get settled on T plus 2, 12th
12.
July.
Yeah.
So here this company, when they are paying dividend, whom will they pay dividend? To the new buyer who bought on 10th July or to the seller?
No, to the seller.
To the seller, right?
Yeah.
Because buyer will become the owner only on 12th July. So that means 10th July, who is the owner? Seller is still the owner. So because seller is still the owner, then that means the buyer is not getting anything here. Okay, he is losing the dividend. So this plan is not working for him. Then when should he enter into the trade? What is the deadline? If he enters into the trade on 9th July, then this will be T. Then 10th July will be what? T plus 1. 11th July will be what? T plus 2. 11th July will be T plus 2. Okay. So 11th July will be T plus 2. Okay. So again, is this enough? Company says 10th July, but you are becoming the owner on 11th July. So you will miss out the dividend. So now let's see 8th July works or not. 8th July will be T. Then 9th July will be T plus 1. And 10th July will be T plus 2. Now, will it work? 10th July?
Yeah, this
Yeah,
should
it
work.
will work, right? Yeah.
Yeah. Yes.
So 10th July, you are the owner. So 10th July, end of the day, company will check the record. You are the owner. So they will pay dividend to you. That means 8th and before 8th, you are free to buy. 8th and before 8th, if you buy, you will get dividends. In other words, 9th and after 9th, you are not eligible for dividend. 9th onwards, you are not eligible for dividend, right? Now, because 9th onwards, you are not eligible for dividend. So, but then see, 9th onwards, you are not eligible for dividend. But because now we are learning here, we are sitting and calculating all this. If you are actually, the investor, would you like to sit like this and calculate, or you want ready-made information? You would like to get ready-made information, right? So when you want ready-made informations, company will not give all this ready-made information. Company will give all these dates. So that ready-made information, that 9th onwards, 9th and after 9th, you are not eligible for dividend. So, so 9th July, this has to be informed to you. Ready-made information has to be given to you. That information will be provided by the exchange. Okay, this information is provided by the stock exchange. They will say that this is the X date, also called X dividend date. X dividend means what? From this date onwards, you are not eligible for dividend, 9th July. So 9th and 9th July, you are not eligible for dividend. That is X date. So what do you mean by X date? X date means the date on which, on or after, the date on or the date on or after which, if you enter into the trade, if you enter into the trade You will not be eligible for, you will not be eligible for dividend. Okay, this X date, very important one. Okay, and it is provided by whom? The stock exchange, not the company. That is also an important point. Is it okay?
Yes, sir.
Okay.
Yes, sir.
Yeah. Yeah. Okay. Yeah. From here on, all sums. Before that, I said, like, I missed one topic. No, I will just go there and brief about this. Yeah, this one. Now here on, all calculations will be in, which will be very interesting as well. And I think that is the last. Next one is the last reading as well. Okay. So maybe in 2-3 sessions, it should be equity should be over, and that will be interesting as well. Calculations all. Okay. Hmm. See how to value equity now. Okay, how to value equity valuation model. Equity valuation model. See, imagine first, uh, I'll give you one analogy, okay, before coming to this one. Let's say you there is a real estate. Okay, now how do you value, on what basis will you value this real estate? You can value this real estate based on, number one, maybe where it is located. Let's say it is located outside railway station. So because it is located outside railway station, so the price will be very high because of easy travel. Okay, so easy travel facility is there. So because of which the price of this real estate will go up. Okay, fine. Now suppose this real estate is not in a near to the railway station, but in a remote village. Imagine there is a bungalow in a remote village. Then how will you value that? So should the value be zero of that bungalow?
No,
Then on what basis will I value?
we can like compare it to other properties in that place.
Okay, that is also correct. Compare. Now suppose there is nothing to compare. Then what do I do?
Then I
Because
think demand and supply.
my village, my bungalow is the only bungalow. Rest all are hut. So what do I do now? I don't have anything to compare.
So I think the land prices.
Land price is there, but what about the bungalow that I spent?
So let's say that
I
would be
spent 50
compared to the
lakhs.
prices of the materials.
Material. So I will say I spent 50 lakhs to build this bungalow. So the value cannot be less than 50 because I myself have spent 50 lakhs. Na? Are you able to understand this? That
Yes.
means you are
Yes,
saying,
sir.
I will say, like, look, I have built this wall, tiles I have put this, whatever multiple floors I have built. So I will say like whatever I have spent, that is called net asset value. Net asset value. Okay, net worth. What is the net worth? Okay, then another one. Imagine another way. Uh, yeah, it is not only easy facility or not only easy facility. Also easy facility. Also, it means that if I put one small shop also over here, the turnover can be very high. So easy outside railways or hospitals and schools, colleges, that is one. Another one can also be, or I'll write it separately, uh, how much cash generation I can get from that place. Say for example, it is again outside railway station. It's a small mobile shop, very small. But then you think about the turnover, lakhs and lakhs of rupees turnover will happen in that small shop. So I cannot go there and say, look, this is a too small shop where only one person is standing. So it must be only 1 lakh, 2 lakh. No, it will go in crores. Why? Because of the turnover that that shop can create. So moral of the story, one product can be valued based on its own strength, and its strength can differ. Like as I said, here the strength is not cash generation. Here the strength is what? The value of the asset. And here the strength is not the magnitude of the place. It is not your bungalow. It is a small shop where only one person is standing. But here, how much cash it can generate. Okay. You got the idea? So the way you value real estate, it will differ. This is comparatively. Okay, my neighbor sold at this price, so my real estate is also this price. Same way when it comes to equity also, how will you value? Now coming to equity valuation models. Okay, so here number one, how
Like
much
DCF
cash?
and all those things.
Yes, dividend discount model. That means how much cash I'm getting from this company. This method, first one,
Okay.
dividend discount model.
Now, one is discounted cash flow method, right?
Dividend discount model.
It is the same thing or
Yeah, discounted. Yeah.
okay.
Okay, this is dividend, and that one is cash flow. We don't have only cash flow in level 1. Cash flow all comes in level 2.
Okay. So
But here
DCF is
this,
different and DDM is different, right?
no, both are same only.
Okay. Both.
Discounted cash, only discounted. Only
Okay.
I mean discounted means only dividend discounted cash flow. Only
Okay.
dividend. Okay, rest all there are other cash flows are also there, but that we will see in level 2. Okay, here only dividend discounted cash flows. Okay, or dividend discount model. Okay, it's also called discounted cash DCF model. That means discounted cash flow. Okay, and discounted cash flow dividend. Yeah. Second one is compare. Compare is called as multiples. It is called as multiples. Compare means multiples. Okay, multiples. Third one is net asset value. Okay, and fourth one is, third one is EV. EV means enterprise value. Enterprise value, that I will let you know. That is similar to compare only. Fourth one is net asset value. Okay, these are the 4 types which are there for level 1. There are other types also, other ways also to value, but that we will be seeing in level 2. Okay, fine. So this is what is mentioned here. So you can read this. This net asset value is also called asset-based model. Asset-based model. Okay. So this is discounted cash flow. Mm. Okay, discounted cash flow. Okay. So you want me to continue further, or if you're tired, we will stop now. So
Yeah,
we
let's do it on another day, sir.
okay, fine. So next time we will continue from here. Okay,
Yeah.
module 46.2. Okay, we'll stop now here. Okay, fine.
Yes.
Yes.
Okay,
Thank you.
okay,
Thank
bye.
you, sir. Bye.
Thank you.